This is the second part video for the which type of loan
Home
should you
equity
get.
line of
Let's
credit,
start.
HELOC. HELOC typically allows you to borrow between 60% to 85% of assessed value of your home minus the current balance of your mortgage. HELOC are type of revolving credit similar to credit card, which enables you to tap into a available pool of money. A HELOC caps the amount money you can borrow and can use it to take out money and pay it back repeatedly for a set time period, usually 10 years. A HELOC usually comes with a variable interest rate. Cash out reference loan. A cash out reference loan replaces your existing mortgage with a new one that may come with a new interest rate, monthly payments, and the loan terms. The loan amount will be larger than the remaining balance on your mortgage, so you can use the extra money for home improvements or other purposes. Personal loan. A personal loan generally features a repayment period of several months to several years and comes with either a fixed or variable interest rate. In most cases, you can spend the proceeds of the personal loan for an array of purposes, including home improvements. Credit card. A credit card is another option to pay for a home improvements. If you have a good credit score, typically a FICO score of at least 670, you might be able to qualify for a card that offers a 0% APR annual percentage rate and use the card to finance a home improvement project. If you pay off the entire balance before the intro period, and you can avoid being hit with interest charges. If you rely on the credit card that you already have instead, you might wind up with a higher interest rate and lower borrowing limits than you would be in a personal loan. Because home equity loans, HELOC, and cash out for references use your homes as collateral, the interest rates are often lower than they are from the personal loans or credit card. However, because your home serves as a collateral on these loans, you could lose your home if you fall behind the loan payment. Loan for paying off debt. For paying off debt can be challenging, especially if you have a high interest rates and several different debts. Two common tactics for reducing your debts includes taking out a debt consolidation loan and using balance transfer credit card. Debt consolidation loan. A debt consolidation loan is a personal loan designed for a paying off high interest debt, often from a credit card. This type of loan lets you combine several debts into a loan with just one monthly payment. Ideally, a debt consolidation loan should provide a lower overall APR, enabling you to save money on interest over the long run. It's a good option if you already have a good credit score, which will help you get more favorable terms. Balance transfer credit card. You might also turn to the balance transfer credit card to help pay off debt. This type of credit enables you to save money by switching of credit card balances to a new credit that charges a low introductory APR or no APR over a certain period of time. Like a debt consolidation loan, a balance transfer card can be attractive if you have a good credit score. Loans for affording college. Broadly, there are two types of student loans: federal loans issued by the federal government and private loans made by the private lenders
such as banks and credit unions.
Federal student loans. There are several types of federal student loans, each with its own set of requirements. Some are available only to the students who have a financial need, while others are offered regardless of the need. Normally, a federal student loan is better than private student loan for covering college expenses. For instance, you may be able to qualify for a federal student loan regardless of your income or credit, while a private lender takes the factors into account. Plus, federal loans can be easier to repay than private pay loans, thanks to government programs such as loan forgiveness and income-based repayment plans. Private loans. A private student loan can give you more borrowing capacity if you have reached the limit for federal loans, but the interest rates are often higher, and they tend to have less flexible repayment plans when weighing your option for private student loans. Look for low interest rates and reasonable repayment terms. You may also find that some private loans offer perks such as cash reward, incentives for good grades, or an interest rate discount if you sign up for automatic payments. Just keep in mind that you won't have access to repayment programs that come with the federal student loan. Our next topic is car loans for financing a car. Just as you shop around for a car, you should shop around for an auto loan. Looking into several auto lenders may lead to a low interest rate and other favorable lending terms. Common sources of auto loans are bank credit unions, car dealers, and online lenders. Keep in mind that the credit union can pre-approve you for a car loan, which can give you an edge in terms of securing the best interest rate and sale price. Among the factors you should weigh when you are applying for a car loan: APR. Find a lender who can offer the most appealing APR. Remember that the higher your credit score is, the lower the APR might be. Down payment. Lenders often have a minimum requirement for how much money you are required to put down for a car purchase. Also, if you are able to make at least 20% down payment, a lender might offer better terms or lower interest rates. What are the terms? The term is a number of months you have to pay back the loan. Common loan terms are 36 to 72 months, but some can be longer. The longer the term, the more you will pay in total interest rate for the car. Monthly payments. Consider how much room you have in your budget for monthly payments. One reason people take a longer loan term is to secure a lower monthly payments. The bottom line: regardless of what kind of loan you plan to get, check your free experience, credit report, and credit score ideally well before you start the application process. This knowledge can better equip you to make decisions about your loans, possibly give you time to improve your credit profile so you can get the best rates and terms possible. That is it, guys, for today's video. Hopefully I will see you in next video. Until then, bye bye.